Welcome to the PH4410 review of the dealer's model. Now in previous video reviews we have talked about the toy icing model, which is a toy model of the stock market, very highly simplistic, but the physicists believe that it captures essential features of the stock market. We also talked about the Santa Fe artificial market model. This is a genetic algorithm based model of expectation formation as well as trading strategy, switching between traders in a this so and so this that would be more in line with the kind of axioms economists assume in deriving their rational expectation theory. Uh, in this particular video, let's look at another kind of model. Nonetheless, it is still a toy model, but it's developed by a physicist, developed by a group of physicists, but it is a model of the order book itself. So here, so let's write that down. This is a toy model of the order book. And what we have is n traders, okay, and one stock again, okay. And each of the trader is represented by a bar. Okay, this particular trader will buy. Let's say for trader I will buy 1 unit of the stock if the selling price of this is below BI, and he will sell 1 unit of the stock if the selling price, if someone wants to buy it for a price higher than SI. So all the traders in the model would have would be represented by a bar like this. So for example, BJ and SJ for trader J, and the condition is that transaction between I and J. So transaction between I and J, okay, that is if BI is greater than SJ, in which case I buys from J. On the other hand, if if not BI but S, on the other hand, if SI is less than BJ, then I sells to J. Okay, so graphically, this can be shown in this way. So if I have a situation like this, I and J, so BI here, BJ here, SJ and SI. So since SJ is higher than BJ, this is a situation where there is no trade. Okay, but if we have a situation like this, okay, I and J, so this is BJ, this is SJ, and this is BI, and this is SI, where a trader I is willing to buy at a price BI that is higher than the price SJ that J is willing to sell at, then there will be a transaction, and the transaction is 1 unit of the stock will go from J to I. Similarly, or conversely, if this happens, okay, this is I and this is J. Here we have BI, SI, BJ, SJ. If the buying price of if the bid price of J is higher than the ask price of I, then there will be a transaction. 1 unit of stock will go from I to J. So this is the and what happens after a trade is that, suppose we have a trade BI, SI, so this agent I, and then we have J, BJ, SJ, SJ. So there is a trade where 1 unit of the stock goes from I to J. But what is the price? What is the price? of this stock here. The price of this stock is actually the average between BI and SJ. So P, the transaction takes place at this particular price, BI plus SJ divided by 2. And after the transaction, since the price has been since trader I and J have discovered the price, we will make it such that the midpoint of the price, the two reserve prices for trader I and J are exactly at P, which is 1/2 BI plus SJ. So this is the new price, BI prime, SI prime, and this is BJ prime and SJ prime. So the traders I and J will revise their reserve prices for buying and selling such that the midpoint agrees with the new price of the transaction. And of course, this alone would not give you interesting dynamics. What happens is that at any time, any point in time, okay, the two reserve prices can also perform random walk, okay, of the size sigma dz, okay. And if you in order to have this model agree more closely with the real world, based on stylized fact that observed in the real world, sigma can depend on the volatility within a small time window, okay. But more importantly, if say this is the price range for trader I, and the actual price, the most recent price is here, or the average of the most recent prices is down here. We also want more steps to be taken towards P bar, and less steps to be taken away. So there is a bias of the random walk towards P bar, and we call this the price trending aspect of the dealer's model. So the dealer's model can be used to explain the return distribution, the trading interval distribution, as well as volatility clustering.